As part of an investor pitch, you're going to need to identify a company valuation. Well, generally, the company valuation is done by basing the company's value on market or deal comparables. That is, when similar companies out there in the market have received investment financing in recent times, what has been the valuation of those companies based upon their size and operating characteristics? And what you'll try to do is derive from that some common metric that you can use to value the current company. If the metric is based on revenue, then you would simply whatever metric or multiple times revenue, right? And that's going to help you come up with a valuation of the company. If it's a company that's growing in terms of users rather than pure revenue at this point, then you'll use some other metric about number of acquired users and then, growth and the attrition of users along with that growth to dictate. So what you're doing is you're taking the unique characteristics of your business, finding another business in the industry that has received capital funding or been purchased by a strategic acquirer, and you're taking some multiple that identifies the crux of how that company grows, and you're using that metric to value the current company. Other methods that are used in traditional methods of finance, like discounted cash flow models and even pure asset valuations, don't work for the startup. One, the cash flows are very tenuous at best and very difficult to project. So using that as a valuation method just doesn't work. And then most of the assets of value to a startup are intellectual property. And again, that's very difficult to value. So anyway, you're looking at market comparables and deal comparables. Okay. Then you're going to state what type of equity instrument you are issuing. Are you selling preferred stock in the company? Is it really early and the difficulty of evaluation makes it better to sell a safe or a special agreement for future equity? That's an agreement to allow the investor to purchase an ownership interest at some point in time in the future with a cap in valuation and at a discount from the future rate. So basically whatever is invested now will be used to purchase an ownership interest in the future, but at a discount, and the value of the company will be capped for purposes of determining how much of an interest that buys. So it's a good deal for the investor. And the same goes for a convertible note. It works very similarly, except rather than a contract right, it's actually a debt instrument that converts to equity at some point in the future, but has, again, a cap in valuation and some discount associated with it. So you'll state the terms of the raise, how much money you're raising, and what percentage of the company that equates to based upon the valuation of the company. So this is where you make the ask of investors and lay out this portion that they'll need to know to understand the nature of exactly what they'd be receiving in return for their investment.